Hi, I'm Peter Crowley and welcome to Money Thoughts, your financial education show that helps you better understand how to manage your money. My co-host Deb Frazier is off today. Our show today is sponsored by Princeton Global Asset Management, a national investment company located in Princeton, New Jersey. But today we're going to talk to you about you, the individual investor, and what you should be looking at when you're making decisions. Our guest today is Brett Shaver. Brett is the president and portfolio manager of Princeton Global Asset Management. Welcome, Brett.
Hey, Peter, how are you?
Good.
It's a pleasure
good,
to be
good.
here.
Thanks a lot. So I got to start off with the big question. We're in an environment right now where the market is not going up, it's going down.
Correct.
And lots of reasons for that. But from an investor's point of view, when you talk to your clients, what do you tell them?
Yeah, exactly. It's a great question. The big issue this year has been one word: inflation. And what has happened as we sit here today, the market's been down 7 weeks in a row. So it's a bit of uncharted territory. It's been about 20 years since we've seen the market down 7 weeks in a row. So not only have we seen a significant correction in the market, it's also been over a lengthy amount of time, which I think is starting to wear on all our patience and comfort with being invested. So, and what has happened this year is, the Federal Reserve has made it their top priority to tame inflation, and to do that results in rising interest rates, and at some point sacrifices the returns in the market in the short term. So what we've seen is the Fed has moved much more aggressively rising rates, and what that does is slows the economy down, and it's created some volatility in different asset classes. So we think it's the right decision longer term, what the Federal Reserve is doing, and how we're talking to clients is, after a pretty good period where the Fed has been extremely accommodative, which always helps stocks, we're in kind of a digestion phase or a correction phase for the near term. We continue to expect volatility, but we're confident and optimistic on the longer term of being invested in the stock market. And the main message is just stay the course throughout this period.
So as an investor, is the market in trouble? If I'm looking, do I say, well, that market's in trouble?
Exactly. It's a good question. I think it depends on the perspective you have. So longer term, we're very optimistic on the market. Longer term returns over any 10-year time horizon are positive generally for stock markets. What we've been telling clients is, your good investments, they're down but not out. They will come back. One thing we look at is investor sentiment. We all feel the same way right now. We're all very concerned about what's happening in the markets. We're kind of at historical lows of how people are perceiving the investment markets right now, which oddly is it's a bullish contrarian indicator, which means looking forward, when you see sentiment this low, it means returns will be positive. So as we look at a 1-year time horizon, we're much more positive. 10-year time horizon, we're always very positive, and we think it's a good time to be investing. What happens on a day-to-day basis and with the volatility, we expect it to continue until we have a better path of how the Fed and some of the inflation readings we're seeing. And plus, we're dealing with a lot of uncertainty you had with the what's happening in Russia, Ukraine, and the China lockdowns. We just think that's exacerbating some of the issues with inflation and what the Fed's dealing with.
So as an investor, you hear about bull markets and bear markets. We're in what I guess is considered a bear market.
Correct.
And they say when you're down 20% from the high, you reach a bear market. What does that mean?
Yeah, it's a good question. And technically, as of last week, we did enter bear market territory briefly. The market did recover slightly. We'll see where
bear
we
means
are.
The market's heading down, right? Bull means it's heading up.
Exactly
Okay.
right. So bull market is the market is in a sustained uptrend. A bear market is a downtrend. The technical term is that it's been a 20% type correction. So we saw the S&P 500, which is the major indicator for U.S. stocks, or major benchmark for U.S. stocks, was down 20%. Other benchmarks, actually the NASDAQ, which I think we see frequently if you look at the ticker, the NASDAQ's actually been in a bear market for a while now, and the NASDAQ's down over 30%.
And the NASDAQ is what?
The NASDAQ is, it's primarily is technology companies.
Okay.
So it was formed by the NASDAQ exchange and companies listed, which has historically been more tech. So it's very growth tech focused, as well as a lot of healthcare companies are in.
And the Dow is the top 30 or 30 stocks that are considered to be the top stocks, and they track
Exactly
those.
right. So the Dow Industrial Average is 30 stocks, and the idea is to have a representation of stocks which represent the economy or how an overall market was doing. So a little bit narrower than the S&P 500, which has 500 securities.
Okay. So let's talk a minute about risk. You always hear about risk in the market. How does an individual investor evaluate risk?
Yeah, it's an excellent question. I think risk is future returns are not guaranteed, I think is a way to think about it.
Okay.
Or you're putting money at risk. So non-risk would be, think about your checking account or savings account. With any investment, and most investments we have from client, there are varying degrees of risk. So what we do is we work very closely with our clients and understand how much risk they can tolerate in any market environment. So even within stocks is generally a riskier asset class, but even within stocks there are, let's say more stable, lower risk securities as well as higher risk securities. So that's our job, is to analyze the first thing we do is work with our clients, understand what risk they can tolerate, because the last thing we want is an environment like this, to have you hit the panic button at the wrong time. Mm-hmm. So, and that's making sure we don't have, we have the proper risk in the portfolio, we have the proper allocation of stocks, we own the right stocks for clients, as well as we have even the right cash balance and even owning the right fixed income or bond instruments.
Now, when they say rebalancing a portfolio, which portfolio means the investment money that someone's invested, what does rebalancing include, especially in an environment that's sort of more risky?
Correct. It's a good question. How we approach clients is we're very engaged with our clients. We listen to them. We do financial planning, and the one thing we said is, what is your proper risk tolerance? And then we'll set what's called an asset allocation. An asset allocation is taking all your investments and figuring out how much should be in, let's say, stocks, how much should be in bonds, how much should be in cash, how much look at certain even other investments or alternative investments. That's forming a plan and having a long-term strategy in place. Rebalancing would be when you get these periods of volatility, and the volatility can be to the upside or the downside. So rebalancing would be, after the last several years, we've had a very good market run. One of the rebalancing at that point would say, thinking about the future, your stocks have become too much of your portfolio. You're taking too much risk in the stock market. Let's rebalance and pare that back down a bit. Same thing happens in bear markets as we're experiencing now. So we've seen a correction, and we're talking to some clients, and now we're saying, why don't we think about rebalancing and adding a bit more to your stocks. Mm-hmm. As you have a good amount of cash, you have a good amount of fixed income, you can withstand what's happening in the market volatility and kind of adding back to make sure we meet those long-term goals that we talked about.
So in a market where volatility, which is the market sort of all over the place, in my risk tolerance, I don't ever want to lose money. Okay, that's most investors' risk tolerance. I don't want to lose money. So they say, well, gee, the market's down a little bit, so I should jump in and buy stocks that look like they're at the low point. What would you recommend to someone who says that? Is that a way of looking at investing?
It's, I think we'd have to, go to another level of a conversation like that. So I think, where we are in the market right now is, here we talked about, are we going to rebound and recover? And I think when we look at different investments, there are a lot of stocks right now that are down significantly, but we still think are extremely risky. So, what we've seen is, we'll call them more of the speculative investments. So, in a zero interest rate environment, you kind of see investors kind of, animal spirits come out, or they're very excited, and start speculating in stocks versus investing in stocks. And we've seen a lot of those stocks that come down, and we still view them as very speculative investments. So we do think some of those stocks have come down, and maybe they won't recover from these levels, and there could be further. So the idea of not losing money over the longer term, those type of investments would make sense for us. We do think, if you have, what happens in the next 3, 6, 1 year, it's very difficult to tell over cycles. But if you think about a good quality investment portfolio over a 10-year time horizon, we're very confident that you'll do well and have positive returns over that time period. So that's the biggest thing, is looking at the investment and picking the right quality investments that will hang in there.
So from an investor's point of view, if I have very low risk, I don't want to ever lose money, then my investments are more stable. Bonds are more stable, like even savings accounts.
Correct.
They don't pay a lot, but they're not going to lose me money, correct?
Exactly right.
And if I want to get more volatile or take more risk, then my investments go into stocks. And some of those stocks can be more speculative, which I guess is higher risk.
Correct. I think that's the way to think about it. But it's interesting because actually by creating a portfolio, you can add some risky assets to what you think is cash or bonds, and it can actually reduce the risk in your portfolio.
How do you do that?
Well, think of an environment like we're in now,
right,
where one of the biggest concerns is inflation. So historically, stocks have worked to guard against inflation, where bonds and cash, if inflation stays higher for longer, the value of those, you'll just be able to buy less with the cash that you have in the portfolio.
Right.
So adding some good quality stock investments to the portfolio can actually reduce your risk overall.
Interesting. So you hear about value investing, growth investing. What is the difference between value and growth? And those are two terms I know investors like myself hear all the time.
Yep. Great question. It's something we even struggle with defining on a day-to-day basis. We feel many of them overlap. But I'd say here's how we would think about value stocks. So value stocks are more in your, less exciting, more your classic cyclical industries. Cyclical industries meaning when the economy's doing well, the companies will see earnings growth. When the economy's not doing well, they'll see earnings declines. A lot of these companies will pay dividends back to their shareholders. Dividends when the company actually rewards the shareholder by paying them a check, usually on a quarterly basis. So the reason they pay dividends is they see reinvesting in their business maybe isn't exciting because the growth prospects aren't as great. So they pay that cash back to shareholders. Good example, think of different industries that are more value focused. Think of the banks, think of energy, think of some of the consumer products companies, materials, chemicals companies.
And they're your value.
They would be your value type investments. And we hear the word all the time, thrown out with value stocks are doing, haven't done well or doing better this year, et cetera. So those would be your value types.
And growth would be more of your, I'm not going to pick on any one segment, but maybe technology, maybe social media or things like that are still, don't have a real long track record of success, but look like they're going to be good going forward.
Exactly right. So the growth stocks, if you look at the industries or sectors that compose more of the growth, it is more technology, it is more healthcare, internet, some of the consumer discretionary names. And with growth stocks, those companies tend not to pay dividend because they see that the cash that they have is better reinvested back into their business so they can continue this growth cycle that they have and generate more growth in the future. A primary example of a growth company would be in the market right now is Tesla, which one thing we look at is, valuations of the company. Tesla looks very, we'd say, expensive. For the price versus how much its earnings right now, it looks expensive. So you're paying for the reason you own the stock is for what you perceive as the future growth of the company versus the growth you're getting today or the cash you're getting back from it.
So in that type of environment, then you've talked about inflation, which is going up, which I would think means that higher growth companies have to borrow funds at times. That costs them more money. Does that impact how their returns come?
It has, and what we've seen this year as interest rates have risen, inflation is concerned, we've seen value stocks do better than growth stocks this year. So, Peter, to that point, if a growth company is borrowing, it does become more expensive to fund their growth. And the other issue, and this is a bit technical, but with growth companies, we're valuing what their future earnings will be, and we pay for that. So as interest rates are higher, it demands us to pay a bit more for what those future earnings would be, and they're worth a bit less in the present day. So it's kind of a present value of money concept. So.
Okay, we can get into that. We're going to get into bonds. We're going to get into investing, and we'll get into what a fiduciary is when we come back to Money Thoughts. And we're back with Money Thoughts. I'm Peter Crowley, your host, and we're Brett Shaver from Princeton Global Asset Management. So Brett, we were talking about different investing styles. Let's just shift a second to go to bonds for a minute. You talked about bonds being a safer type of investment. Can you give our audience a little bit about why would someone invest in a bond and what does that mean?
Sure. Yeah, absolutely. So maybe take a step. Stocks would be when you're investing, you become an investor, a partial owner of a company effectively. So you're investing for the future growth and what you think are bonds. You actually are a borrower to the company. So you are effectively lending the company money to receive an interest rate with the idea that you will get that full principal back of the bond.
Principal being the amount you invested. So if I invest $1,000 in that bond, that's my principal.
Exactly right. Exactly right. So, bonds have historically been more stable. So, and what's been interesting is if bonds and stocks tend to be negatively correlated. So, thinking if stocks are up or if stocks are down, bonds will be up. Because in that environment, usually interest rates will be heading lower. It's been different this year, but that's the historical cause. And with bonds, what's something to note is when interest rates go up, the price of the bonds actually decline and vice versa. But to think of a bond, the main thing is if you buy a 3-year bond, you purchase the bond, you receive interest payments from the company. Those could be varying amounts. And then 3 years from now, you will get that principal back if you make the correct bond investment.
That's interesting. I've lent the company money and they're paying me to use my money.
Exactly right.
And they give my money back.
Exactly right.
And that's considered a much safer investment, more of a value investing. Can I say that?
I think that's a fair way to think about it.
Okay.
So, less exciting, but usually safe and stable if you're borrowing from the right companies. There are, of course, all different kinds of bonds, the safest being the U.S. Treasury. I'd say the next level would be high quality corporations and municipalities. And then you can get in some riskier areas where you get a higher interest rate, but they may be companies where there's a little bit more concern where they have more debt or their business is more economically sensitive and there is a little bit higher risk to get that higher interest rate.
So another question I hear all the time is a fiduciary. I'm a fiduciary, I'm not a fiduciary. What is a fiduciary and why is it important?
Yeah. It's a term thrown around a lot in the industry, and as Princeton Global, as a registered investment advisory, we first and foremost we go by the fiduciary rule, and that means that every decision we make for our clients is always in the client's best interest. So, working with our individuals and families that we serve, anytime we are purchasing an investment for their portfolio, we need to make sure it's in their best interest to help them longer term meet their goals, and it's not something that we would get compensated for, directly.
So if you make a decision I don't like, what happens? If you're the fiduciary?
It's a good question. And sometimes, we do our best to work with our clients and always make the best decision, but sometimes, there will be decisions we disagree on. And at that point, we work close with our clients and make sure we're in agreement and move forward. Sometimes we'll talk through it, but anything we recommend, we do think is in our client's best term interest and how they can, live the life kind of, less stress.
So that means that you really have to know your client.
Exactly right.
So is that the difference between a regional firm like yourself, Princeton Global Asset Management, and like a Vanguard or anybody else at that size that you? What's the difference? Why would I go with you versus a Fidelity or Vanguard?
Yeah, it's a great question, and I.
See, good questions. We work hard on this.
Number one is, as a smaller firm, we're very engaged with our clients. That's client engagement is number one. So every client that we work with, we listen to our clients. We get to learn about them. We learn about what their interests are. We make sure we have very good communication. So before we do any investing, we want to sit down and communicate back and forth how our approach is and make sure we're the right fit. And then going forward, we pride ourselves on excellent client service. So any questions the clients have, on their investment portfolio, we're always there to answer, as well as we do, I think a lot more for our clients of any questions they have, even financially related or even things going on in their, lives that might be important to them that we can help out with. So I think that is the biggest difference. I do think, for me personally, I worked at a larger firm, and what we had was we were always focused on selecting the right investments. We just didn't know who those investments were for. We had a mandate, and then we created those investments for Princeton Global, everything we do is a mandate for our client and in their best interest in kind of building, customized investment portfolios for them.
So the question's always going to come up. Someone says they want to use you as their investment manager. How do they pay you? How do you make money on this?
Yes. So we charge mostly it's a fee based on the assets of the portfolio. So
okay.
So think about it, and the way we do is we charge on a quarterly basis. So why we prefer that method is we work as kind of a small general partner with our clients' investments. As our clients do better, we get compensated a little bit more, and vice versa. So that's how we work. That's I think different than other in the industries. One thing to note is we do not accept any commissions. So everything is just fee-based on the client portfolio. I know there's others where they do charge commissions on purchasing or selling certain investments, and it's different than even, think of some of the funds, which they'll pull a fee, but they'll pull that out of the income out of the portfolio. We're very transparent about how we bill our clients. Usually it's debited from their accounts, and we're very straightforward on how that's done.
So that's another word we hear is commissions. And as an investor, I don't want to pay commissions on anything. I just want the person to invest for me. Why do you think it's important that you or anybody who's a fiduciary not take commissions? And how does it sway someone's decision?
Yes. Commissions, commissions was how I think many were perceived in the brokerage business or financial advisory business of how they were compensated. So when you purchase security, the broker would make a commission. Over time, that has evolved dramatically, but there are still commissions for brokers. And I think what that does is it inherently can create a conflict of interest when you're looking to maybe sell an investment into a client's portfolio so you can get a commission. You're incentivizing transactions within the portfolio. And it's very different than fee-based where we want to purchase securities, but they're now even utilizing our custodians that we use. They're commission-free. We think it's important to have one thing is investment turnover in portfolio. Turnover is how frequently you buy and sell stocks. Turnover, I think we like to actively manage our portfolio, but if you turn over portfolios too much, it becomes a negative to returns for multiple reasons, and it's for tax reasons. You have to pay taxes on gains, and it just shows that managers that have a good long-term focus and hold their investors tend to do better. If you're charging commissions, you're almost incentivized to increase that turnover of the portfolio and buy and sell more stocks. Okay,
so earlier you mentioned that over time, stocks can return more than other investments, and there's a historical background to that. You go back 100 years plus to the beginning of the Dow. Can you talk a little about why that's important for a consumer or an individual investor to understand?
Right. So historically, stocks have returned, depending on what time horizon you're looking, about 9 to 10% on average.
And when you say time horizon, can you define that a little better?
Yeah, so time horizon, well, we look at history, so you can go back over a 100-year period or 50-year period or even 25-year period and see what the average returns are of stock over a given year. So, stocks they've rewarded long-term investors by providing 9 to 10% in the portfolio. We think that's important, and we use the word long-term because, yes, stocks are risky. So I think it's important for clients when, they do have good returns, but there is risk in the portfolio. And to be invested in stocks, it's very important to have a long-term view that you're going to own for the longer term. And, 9 to 10% that's great on an annual basis. What's very powerful is how that can compound and grow your assets over time, especially as you have expenditures or inflation or other things in life. That's why we believe it makes a lot of sense to always have some exposure to stocks in your portfolio. There's other asset classes. One of the benefits of stocks is liquidity. So they do grow, but they're also available to be bought and sold pretty freely, and you can access them.
So there's always a ready market if you want to sell.
Exactly right. Exactly.
Even if it's a down market, you can always still sell in that.
You can always sell. Of course, we prefer not to be selling stocks in the
agree.
Down market, but yeah, the liquidity is, and that's different than, let's say, we talk more about private equity or hedge fund or alternative investments. Those, may have good returns in the longer term, but they're less liquid for the clients to access.
So for an investor or any of our viewers who might say, well, gee, I want to use an investment manager, it sounds like a pretty good deal. Are there qualifications that you look at? Are there minimums that you look at? I mean, what makes sense for an investor to work with an investment manager like yourself?
Yeah, and as a small firm with close relationship with our clients, we're looking for ultimately Princeton Global. We're looking for the right clients. So we're looking at various clients, which we'll call builders that are building their assets and saving over time and continue to add to their portfolios. Fantastic clients, and we're also looking at clients that have worked extremely hard over their lifetime and have saved a good amount to refund their retirement. Those are a vast majority of our clients as well, and at that we're looking to grow and kind of preserve their assets. So it's a good. Are there set minimums? No, we ultimately like it's a very hands-on approach, talking with our clients and making sure it's the right fit to have a professional manager like ourselves working with them. Versus, let's say, the do-it-themselves investor, the investor that's purchasing, let's say, mutual funds or other investment vehicles.
So you talked about inflation a little bit, and again, for our audience, inflation means things just cost more, correct?
Correct.
And your buying power, what you can spend, is less. So if yesterday I went out and bought tomato juice and it cost me $1, well, today I go out and buy it cost me $1.25. So I've lost that buying power. What is it that tames inflation? So if we're in an inflationary environment, what is it that's going to tame it and bring it back down?
Yeah, and that's what we're wrestling with today, and the uncertainty, because that's part of the reason the market's down is the uncertainty. Will inflation come back? And what will tame inflation is that's what the federal increased rates. Ultimately, a slowdown in the global economy is what we need. So we think the economy's been very strong. It's been a bit out of sorts since the pandemic.
It's been crazy.
It's been crazy.
I mean, from my point of view as an investor, it's been crazy.
It's been crazy. So, and I think, what will tame inflation is, kind of a pullback or a reset on these very strong demand trends on the demand side, and the other thing is the supply side. So part of the reason you have inflation is due to shortages, supply chain shortages, as we call them, whether it's getting those tomatoes in the tomato juice or even the cans. As we've had these disruptions due to COVID and some of the geopolitical issues we're having now, we're seeing these supply disruptions. So what would tame inflation would be demand slows a bit, as well as some of these supply issues, whether it's manufacturing or even labor right now, there's a little bit slack in the labor, and that's what would ultimately cause inflation to come down.
Although the amount of employment is low, so the unemployment rate is low, that's a good thing, correct?
It's very interesting, yes. The employment, looking at the employment data is inconsistent right now. So the unemployment rate is very low. But what we've seen is the participation rate, since the pandemic, we've just seen less people working. So that's created tightness and a shortage of workers right now. So seeing more people come back to work and be willing to labor force, that would be one of the positives that would help inflation go down. So that's one of the statistics we're watching right now.
So it sounds like it's not unacceptable to work with a money manager. People should think about what they're doing, because you and other money managers work with them. Let's say they want to get involved with Princeton Global Asset Management. What should they do?
Yeah, we're a small company. Our website's www.princetonglobal.com. Our phone number's there, and you call our desk, and Nida, our business manager, would likely answer the call, very friendly, and we'd have a conversation and say, hey, let's have a discussion and let's talk about it.
So that brings us to the end of Money Thoughts. Brett Schaefer, Brett, thank you very much. We enjoyed it.
Great seeing you.
And it's Peter Crowley, and we'll see you next time on Money Thoughts.